Hi, you guys. I'm Phil Town from Rule One Investing. And today I want to talk to you about the difference between swing trading and dollar cost averaging. There's lots of different investing strategies out there, of course. If you're somebody who wants to learn how to invest, it could be a little confusing. I got to tell you, it's easy to be misled by something that sounds really exciting, really promising. Let me just say, if it sounds too good to be true, you know the story. Often I get accused of that myself, right? Where I'm so confident that you can learn to invest and make very high rates of return with low risk. A lot of people think, oh man, if it's too good to be true, if it was that easy, everybody'd be doing it. But here's the thing. If you do your homework and you learn to invest the way the best investors in the world do it, if you follow the Ben Graham, the Warren Buffetts, right, the Lee Loos of the world, who all invest like I'm trying to teach you guys, and learn how to do this yourself, you can do this. It isn't too good to be true. It's very true. It's been true for 90 years, and why not join the family? So, to get a head start, just go download my complete guide to investing for beginners. This will get you started. It's in the description below. Go download it. All right, so now let's talk about two strategies a lot of you have been asking about: swing trading, dollar cost averaging. I understand why you're doing it. The market's volatile like crazy, and both of these tend to be interesting potential strategies for investing. So let's talk about swing trading. Swing trading is kind of right between day trading and sort of longer term momentum trading. Day trading occurs when a trader is trying to take advantage of the ups and downs of the market on a minute by minute basis, right? And long-term trend trading or momentum trading is when everybody's trying to take advantage of a long-term swing in the market. Day traders tend to be individual investors predominantly, and very, very, very good institutional investors. And the best make billions and billions of dollars doing this kind of stuff. The longer-term investors that are called momentum investors, that's pretty much what virtually everybody on Wall Street is doing when they're running a big fund or an exchange traded fund. They're just in it to follow the momentum. The swing traders are kind of in the middle of that. They're going to go in to a position on a stock or an ETF for days to weeks, and then they're going to exit that position with a profit, hopefully. And the first key for successful swing trading is basically picking stocks which are both volatile and liquid and theoretically on sale. So the trick with swing trading, the thing that makes it really hard, is that it's very difficult for swing traders to care about whether a stock is on sale or not, particularly in a market like this one, where almost nothing is on sale. They'd rather just be trading, and they're going to trade on essentially what amounts to short-term momentum. Much harder than long-term momentum, as you can imagine. So there's different kinds of swing traders, and I'm not going to get into all of them. But basically, it relies a lot on technical analysis. It relies on understanding price channels, understanding indicators, and uses different kinds of indicators like simple moving averages and MACDs and so on. Now, those guys are trading based on this is how I look at it, based on looking up in the sky and they see a cloud. And if the cloud looks like a train, they're going to buy. And if the cloud looks like a bunny, they're going to sell. I mean, not literally a train or a bunny. You guys understand, I'm just making up a picture here. But the point is, the cloud isn't either a train or a bunny. It's just an image. And these swing traders are using these images to try to determine what other traders are going to do and get ahead of it. It's a game that's tough to win in a market like this, guys. It is tough to win. Now, dollar cost averaging is very, very simple, but unfortunately, it's also depends on one key thing: that you're ignorant. It requires that you are ignorant, because if you're ignorant, you don't really have any choice. You just have to do it. Dollar cost averaging is sort of your moron's guide to trying to do the best you can in the stock market without knowing anything about it. It's what Susie Orman recommends. It's what, all the financial advisor guys, they're going to recommend it because you can be an absolute idiot and you can do this. And of course, if an absolute idiot can do it, what do you think the odds are that you're going to get a great return? Zero, right? but we might as well explain what it is. Since you probably already know, it's just investing a consistent dollar amount in the same investment over a long period of time. It requires a certain discipline, I'll give it that, but you can take care of that discipline by just saying, here's my paycheck, take this piece out of it every single month and stick it in this stock, SPY, which is the exchange traded fund for the entire market. And what you're doing is you're buying that thing when it's way too expensive, which is the way it is most of the time, and has certainly been that way for years lately. And once in a while, you get to buy it when it's really on sale. The catch with this kind of investing is that you really make the money on it when you buy dollar cost averaging, when you dollar cost average when things are massively on sale. But because people who dollar cost average don't know anything about investing, when everything goes on sale, they're terrified. The market has dropped 50, 60%. The last thing in the world they want to do is put some money in the market. So what dollar cost averaging usually ends up being is people are putting money into it at all the wrong prices until the really good opportunities come along, and then they're scared and they run away from it. So I don't love it. It's, it's some way to reduce investment risk a little bit, but it's not going to give you good returns. So, I'd say swing trading for people who feel lucky and dollar cost averaging for people who feel stupid. The best way to reduce your risk and maximize your returns is to buy really great companies and buy them when they're on sale. Buy them when the swing traders are screaming bloody murder, they're getting killed, and the dollar cost averagers are running for the hills. If you can do this, you will make a lot of money. I can tell you right now, if you do it, be confident. Your prices will go up and you will be really good at making really good rates of return with lots of lower risk than most people ever take. Now, I'd love to hear from you guys. What do you think about swing trading and dollar cost averaging? You like them? Okay, flame me out, leave the answer, and I'll follow up with you. Thanks for watching. Now go play. If you enjoyed this video and feel it was valuable in teaching you more about swing trading, dollar cost averaging, hit the like button. Hey, share the video with your friends. If you want more investing content, subscribe to my channel, and don't forget to click the button there for a free gift